For much of modern history, inequality was treated like background noise. Uncomfortable, sometimes alarming, but ultimately assumed to resolve itself. Growth would fix it, markets would smooth it out. As long as the economy expanded, distribution wasn't worth worrying about. Then one economist changed the lens. Instead of analyzing a few decades, he stretched the timeline across centuries. And by doing that, he quietly destabilized one of the most reassuring beliefs in modern economics: that capitalism naturally spreads wealth over time. Welcome to the Financial Historian, where money, power, and history intersect. And nothing is ever as simple as it appears. This is the story of Thomas Piketty and how his work challenged the idea that inequality is a temporary flaw rather than a recurring feature. This isn't a story about ideology. It isn't about left versus right. It's about what happens when data is followed long enough that convenient explanations stop holding up. Throughout most of the 20th century, mainstream economics focused on expansion, productivity, output, efficiency. The assumption was straightforward: if the economy grows, living standards eventually rise for everyone. Inequality, when acknowledged at all, was framed as transitional, a byproduct of development, a statistical illusion that would correct itself with time. For a while, history seemed to support this view. After World War II, inequality declined sharply across Europe and the United States. Wages increased, middle classes expanded, home ownership rose, wealth concentration fell. Economists looked at this period and quietly treated it as the norm, evidence that advanced capitalism naturally produced broad prosperity. But that conclusion was built on a very narrow slice of history. Piketty's breakthrough wasn't theoretical, it was historical. He turned away from abstract models and toward archives, tax records, estate data, income statistics, national accounts. Not just from one country and not just from one era, but across multiple nations over hundreds of years. When these records were assembled, a different pattern emerged. The post-war decades were not the rule, they were the exception. For most of modern history, wealth was far more concentrated than economists were comfortable admitting. The 19th century, often romanticized as an age of progress and opportunity, was dominated by inherited fortunes. Capital ownership mattered more than labor. Social mobility existed, but it was limited. Wealth reproduced itself. The dramatic reduction in inequality after 1914 did not occur because markets suddenly became fairer. It happened because capital was severely disrupted. Wars destroyed assets. Inflation erased debts. Taxation intensified. Governments intervened on an unprecedented scale. Equality did not arrive gently. It arrived through shock. And when those forces receded, inequality resumed its historical trajectory. This led Piketty to ask the question that made his work so unsettling. Why does wealth tend to concentrate over time, even in democratic market-based societies? Not as a moral problem, as a mechanical one. To answer it, he drew a critical distinction: labor versus capital. Labor income comes from work, wages, salaries. Compensation tied to time and effort, it is constrained. There are only so many hours in a day. Productivity improves slowly. Income growth is limited. Capital income comes from ownership. Assets that generate returns simply by existing. Land, housing, stocks, businesses, bonds. And this is where the asymmetry appears. Capital compounds. Labor does not. Capital doesn't need to work longer hours. It doesn't renegotiate contracts. It doesn't retrain. It accumulates automatically. From this observation came the idea most associated with Piketty, often simplified and often misunderstood. When the average return on capital exceeds the growth rate of the economy, wealth accumulated in the past grows faster than income earned in the present. In plain terms, those who already own assets see their wealth grow faster than the economy itself. Those who rely on wages are trying to catch something that is pulling away. This isn't a plot, it's arithmetic. And over long periods of time, arithmetic dominates intentions. Piketty showed that this pattern repeated itself across countries and centuries. Before the 20th century, inherited wealth structured economic life. After major disruptions, inequality fell. As growth slowed and capital recovered, concentration returned. This wasn't a temporary malfunction, it was a tendency. That's why Capital in the 21st Century landed so forcefully when it was published in 2013. It challenged the comforting belief that inequality primarily reflects effort, skill, or merit, and that markets naturally reward contribution over ownership. Piketty didn't deny that markets generate wealth. He demonstrated that markets are extremely effective at preserving and amplifying existing wealth, especially in low-growth environments. When growth is strong, wages can rise alongside capital. When growth weakens, capital continues to compound while labor stagnates. The consequences are visible everywhere. Rising housing prices benefit owners, not renters. Stock market gains reward those already invested. Inheritance matters more when returns outpace income. Opportunity becomes increasingly tied to timing, whether assets were acquired before prices escalated. Compound returns are indifferent to effort. This perspective unsettled critics across the spectrum. Some argued Piketty underestimated innovation, entrepreneurship, and technological disruption. New industries can break old fortunes, and sometimes they do. But his argument was never that mobility disappears. It was that at the system level, mobility does not offset the compounding advantage of capital. Exceptional outcomes do not define averages. Supporters saw something else, a long-term map of how money and power interact, and how easily narratives form when analysis is confined to short windows. If you study only the post-war boom, inequality appears solved. If you widen the lens, it appears structural. This is where the real value of the work lies, not in specific policy prescriptions, but in perspective. Viewed across centuries, inequality stops looking like a failure of individuals and starts looking like a predictable outcome of how capital behaves when left to accumulate. The timing of the book's release mattered. Asset prices were rising, wages were stagnant, central banks were injecting liquidity into markets. Yet the dominant story insisted the system was fair and self-correcting. Piketty didn't confront that narrative directly. He extended the timeline. And once the timeline expanded, patterns emerged that short-term thinking obscured. Periods of equality were rare. Wealth concentration was recurrent. And historically, the forces that reduced inequality were not smooth market adjustments. They were disruptions, wars, inflation, taxation, political upheaval. Inequality declined not because capitalism matured, but because capital was interrupted. This reframing posed uncomfortable questions. Who benefits when asset prices rise faster than wages? Who gains when growth slows but returns remain high? Who is insulated and who is exposed in a compounding system? Piketty never claimed to offer simple solutions. What he provided was a diagnostic, a long-term X-ray of accumulation. That's why the reaction was intense. Critics emphasized innovation and mobility. Defenders emphasized structure. But the data pointed to a difficult conclusion. At the macro level, compounding returns on capital tend to outweigh countervailing forces. In mature economies with slow growth, ownership increasingly matters more than contribution. Timing matters more than effort. This insight clarifies many modern frustrations. Why housing feels perpetually out of reach. Why stock markets surge while wages lag. Why inheritance grows in importance. Why financial security depends less on careers and more on asset exposure. In low-growth conditions, capital doesn't need many advantages. Time is enough. This also explains inflation's uneven effects. Inflation erodes wages and cash more quickly than it erodes assets. When asset values rise alongside or faster than inflation, inequality can widen even as policymakers declare stability. The system isn't malfunctioning. It's operating as designed. Reducing Piketty's work to a moral argument misses the point. His contribution was showing that inequality persists unless actively countered. Markets allocate returns to ownership by default. Understanding that doesn't force a political stance, but it does change how risk, opportunity, and security are interpreted. If wealth tends to concentrate, financial literacy cannot stop at budgeting or discipline. It must include how assets compound, how long-term dynamics overwhelm short-term effort, and how systems behave over time. Piketty shifted the question from why inequality exists to how inequality reproduces itself. Once that mechanism is visible, different questions emerge. Not how hard should I work, but what do I own? Not is the economy growing, but who captures that growth? Not is the system fair, but what does it naturally do over time? History doesn't repeat, but capital has habits, and one of its strongest habits is accumulation. Piketty didn't argue that inequality is morally inevitable. He showed that it is mechanically likely. Disruptions can alter outcomes, policies can intervene. But none of that happens automatically. Understanding inequality isn't about resentment, it's about realism. Because mistaking a structural tendency for a temporary phase doesn't just distort history, it distorts risk. If this gave you a new perspective, subscribe.